Let's take a look at how the performance of the market impacted the Wespath fund returns. With that, I will turn it over to my colleague Karen Mansko for the update.
Thanks, Joe, and hello, everyone. I'm going to start off the performance discussion by first talking about our flagship balanced portfolio, the Multiple Asset Fund. As a reminder to our viewers, the Multiple Asset Fund has a long-term strategic allocation to 65% equities, 35% fixed income. It's also important to note that there's been no strategic changes within the Multiple Asset Fund since we had our last update. On the slide, you can see the allocation the Multiple Asset Fund has to each of the individual Wespath funds. What I like about this slide is that it really showcases the broad level of diversification the Multiple Asset Fund offers our investors. The next chart shows the net of all fee performance of the individual Wespath funds versus their respective market indices. Looking at the first column, this showcases the third quarter results, which we did see some market declines in the third quarter. The Wespath funds that comprise the Multiple Asset Fund were down for the quarter and modestly underperforming their benchmarks. Focusing on the two equity funds, which are the first two funds directly below the Multiple Asset Fund on the slide, these two funds comprise 65% of the Multiple Asset Fund and were the primary driver of the quarter underperformance. What impacted these two funds were the stock selection by the underlying active managers within each of these funds. I'll highlight in a moment specific companies that impacted the performance. Also, the U.S. Equity Fund has an underweight to mega cap stocks, which are the largest U.S. companies. This detracted from performance as we saw strong gains from these stocks for the quarter. On a positive note, the two equity funds allocation of private equity contributed to the fund's performance, as we've seen strong results posted from this asset class for the quarter and year to date. Moving on to the two bond funds, starting with our fixed income fund. Looking at the chart, you can see that the fund and the benchmark were relatively flat for the quarter. The Inflation Protection Fund posted positive results for the quarter, surpassing the fixed income fund, but underperformed the fund's custom benchmark by roughly 0.5% net of all fees. Despite the near-term underperformance we experienced from the Multiple Asset Fund, looking at the long-term performance, the fund has outperformed its benchmark net of all fees for the 1, 3, 5, and 10-year time horizon. Just to highlight as I conclude on this slide is that we've seen a rotation in the markets from what transpired last year and the year before. The stock market as a whole has been up year to date, but the areas of the market that are outperforming are much different than what outperformed last year and even years prior. At Wespath, when we make investments and allocations to various asset classes, we make them for the long term. And we do not get swayed to make drastic changes in our funds by near-term out-of-favor investments and strategies. As we've showcased, our long-term strategic approach to investing has served all of our investors well in the long term.
So Karen, I know we like to show the multiple asset fund versus its index, but how did the multiple asset fund perform relative to its peers?
You're right, Joe. We not only like to measure how the fund compared relative to its benchmark, but also show how it's done compared to its peers. And this is using a composite that's compiled and maintained by our custodian Bank of New York Mellon. The information on the slide is updated only through August, since the September data is expected to be released later in the month. You can see on the chart that the Multiple Asset Fund has outperformed the median foundation and endowment portfolio in the 3, 5, and 10-year time horizon, and performed in the top quartile for the 10-year, which means it outperformed over 75% of its peers. In the 1 year, we are below median, and the reason is because relative to foundation and endowments, the Multiple Asset Fund has a smaller allocation to alternatives, such as private equity. In the Wespath funds, we posted nearly 40% gains for this asset class year to date. Foundation and endowments that are part of this comparison likely have 20% or more invested in this asset class, and MAF has roughly 4%. We understand that some investors would like a higher allocation to alternatives, which is one of the drivers behind us launching our own fund next year.
So Karen, moving on, tell us about the individual fund contributors and detractors for the quarter.
Yeah, starting with our Multiple Asset Fund. I talked briefly about this on the performance slide, but you can see the primary driver of the fund's underperformance for the quarter was the modest underperformance of the 4 funds that comprise the Multiple Asset Fund.
So I mentioned during my comments that we continue to see strong performance across the board from the market on a year-to-date basis, but some equity markets were flat, if not down, for the third quarter. So how did this impact the U.S. equity fund performance?
Yeah, that's right, Joe. The markets gave up some of its return in the third quarter, which happened in the month of September, since in the month of August, the markets hit all-time highs. The only U.S. stock market that ended in positive territory for the quarter was the S&P 500, which was up about 0.5%. This obviously had a negative impact on the U.S. equity fund's quarter performance, since the fund has a long-term strategic bias of underweighting large-cap stocks, primarily mega-cap stocks, and having an overweight to small and mid-cap companies, which were down 1.4% for the quarter. Despite this, the fund modestly outperformed by 2 basis points for the quarter gross of fees. You'll notice on the slide that we mentioned the underweight to mega-cap stocks as being a detractor rather than stating large-cap stocks. And the reason is that our fund is underweight mega-cap stocks such as Google, Microsoft, and Apple relative to the fund's benchmark.
How much is the fund underweight in mega caps relative to the benchmark?
The fund is underweight roughly 13% when you compare to the Russell 3000 index, which is the fund's benchmark. Another detractor to the fund was the active all-cap growth manager stock selection, specifically in healthcare and technology companies. Companies such as Teladoc and RingCentral were down 37% and 24%, which is quite a difference from last year when these companies posted strong results. For instance, Teladoc was up 138% last year. This year, we saw a migration out of growth stock names and into the less growthy names, which has impacted Teladoc and also companies like it. On a positive note, the fund's allocation to private equity contributed to the fund's performance. As I noted earlier, private equity investments this year have posted some solid returns. Also, our exclusions to defense and alcoholic beverage companies due to our ethical exclusions also contributed to the performance. Turning our attention to our international equity fund, the international developed markets did not decline as much as part of the U.S. market, but there was still down about 0.5%. With this said, the fund's underweight to developed international markets modestly detracted to the fund's performance. Also, emerging markets were down 7%, which was primarily due to China, which was down 18%, as you noted during your market update. The detractor to the fund's performance was similar to the U.S. equity fund, where stock selection by the fund's active managers was the main driver of the underperformance. Alibaba, which is China's version of Amazon, was down 36%. Also, a German e-commerce company called Zalando, which is an online fashion and lifestyle platform, was down 24% this year after being one of the top performers last year.
It seems like the main driver to stock selection or to equity funds that you just reviewed were companies that were out of favor, or they were, in favor last year and even years before, and they're out of favor now. So is that a fair assessment? And have we seen any changes from our active managers in light of the stock selection issues?
Last year really was an extraordinary year in the equity markets, and I think it's worth reiterating that our investment managers invest in companies that they believe will generate oversized returns over a multi-year period. They do not invest to capture just short-term gains. In fact, one of our most successful managers has been invested in a third of their portfolio for over 10 years. This manager likes to say that they invest in companies that save time, lives, money, and headaches, or provide exceptional value to customers.
So moving on to the fixed income fund performance. I noted during my market update that bonds have improved since their rocky start at the beginning of the year. Specifically, high yield bonds have done well and are up 4.5% year to date. Global bonds, mainly emerging market bonds, have not fared so well due to some of the political issues transpiring in these parts of the country or parts of the world, and the low vaccination rates. How did this impact the fixed income fund performance, given that it's a global fixed income portfolio? It's
been quite a challenging year for the bonds, with the exception of high yield bonds and U.S. inflation-linked bonds, which I'll get to more when I talk about our inflation protection fund. As you showcased earlier, high yield bonds were up over 4.5% year to date, with other bond asset classes in negative territory. The U.S. aggregate Treasury index is down over 3% year to date and down over 4.5% for the 1 year ending September 30th. When you compare the yield curves, you see how the yields increased from the end of last year and to the end of the third quarter, which had a negative impact on the bond market year to date, with the exception of high yield. It's also worth mentioning that the U.S. dollar increased relative to emerging market currencies during the quarter, which had a negative impact on those allocations in our bond funds. With this said, the fixed income fund modestly underperformed its benchmark by 3 basis points gross of fees for the quarter. Focusing on the left side first, the contributors, the fund's overweight allocation to high yield bonds positively contributed to the fund performance, along with issue selection by our emerging market debt and core plus managers. Also, the fund's allocation to alternatives contributed to performance. Detractor to the fund performance include our overweight allocation to global and emerging market bonds, specifically emerging market bonds, as we saw the dollar increase relative to those currencies for the quarter.
So Karen, the rising dollar had a negative impact given that the fund has an allocation to non-dollar bonds. So why did we see the dollar increase during the quarter?
There's a lot of reasons why it's outperforming other currencies. There are many factors that impacts currency movements and also valuations. Some could be the confidence in our Federal Reserve. It could also be the confidence in our GDP growth. But it could also be that relative to developed markets, the interest rates in the US are higher. Therefore, the carrying trade is still alive. If you borrowed in the yen at the beginning of the year and invested in short-term US interest rates, you would have made over 8%, which I find interesting. The final piece I'll mention before I move on is that our allocation to our internally managed PASA social purpose lending program and commercial mortgage-backed securities detracted from performance. And the reason is because we saw spreads widen in this market sector, which negatively impacted the quarter returns.
All right, so moving on to our final fund, the Inflation Protection Fund. This fund has posted some solid gains this year, as you highlighted during your update earlier.
Yeah, despite the modest underperformance by the Inflation Protection Fund, it's really showcased its purpose this year, which is a fund that was created to protect investment portfolios against unanticipated inflation while providing a stream of income. So relative to the fund's custom benchmark, the fund is underweight global and UK inflation-linked bonds, which performed well during the quarter. The interesting thing to know is that UK inflation-linked bonds is that their duration is quite long.
So how long is the duration for UK linkers?
I believe the longest maturity is about 50 years, which this means is that the asset class is very sensitive to interest rate increases. And the UK is experiencing inflation concerns like the rest of the world. Therefore, some actions that may be taken by the Bank of England to control this inflation is to increase rates, which will create some volatility in this asset class. Moving on, despite the U.S. Treasury inflation-protected securities having strong performance year to date and for the quarter, the fund's overweight allocation to this asset class detracted since it could not keep pace with the fund's benchmark, which includes a 10% allocation to commodities. And as you noted earlier in your update, Joe, commodities were up 29% year to date and 6.5% for the quarter.
Yeah, Karen, that's a great point you make regarding commodities. The Inflation Protection Fund has a 10% allocation to commodities, and they posted strong results throughout 2021 so far, but I don't see them listed as a contributor in the attribution.
Yeah, great observation. As I mentioned, the fund has a 10% allocation to commodities, which was a strong driver to the fund's absolute performance. For the quarter, our commodity returns were relatively in line with the index. Therefore, it didn't contribute or really detract to the fund performance. Therefore, it's not listed. The last update before I turn it officially back to you, Joe, is the fund's out-of-benchmark allocation to floating rate senior secured loans detracted. The reason's quite similar to the reason the U.S. Treasury inflation-protected securities are also listed on this slide. The asset class had posted strong results, but senior loans underperformed the fund's custom benchmark.
Great. Thanks for that update, Karen.